Thank you everyone for joining us for another Learning Lunch hosted by ForemanApproved.com. My name is Brian Johnson. I'm the Senior Director of Online Training and Education with Foreman Approved, and I'll be your moderator today. Today's Learning Lunch will cover improving the valuation of your practice by leveraging health IT investments. We are joined today by Michael Sarlitto of A Third Way Medical. Michael is an expert in enhancing valuation for medical practices and other organizations. You can see his expertise there on the screen, which is considerable. In this period of uncertainty and consolidation in healthcare, we're honored to share his expertise with you. Remember that you can ask questions of our presenter at any time by entering them into the chat area during the presentation. We will hold those questions until the second half of our session, when we will address as many questions as time allows. If we do run out of time, written answers to the questions will be posted to our website and sent via email link later in the week. Also, our guests often ask us for a copy of the slides. All registered attendees of today's session will receive an email with links to both the slides and the recorded version of this event. All right, Michael, well, thank you for joining us today.
Oh, it's a pleasure to be here, Brian. Thank you very much.
Well, we have a lot to cover, and it's an interesting subject, so let's dive right in. First, how would you describe the current healthcare industry investment environment? What's the landscape look like?
Well, relative to U.S. healthcare spend, as you can see on the slide, significant growth in percent of GDP, 18% in 2010 with a current estimate over 20%. What I would like to say is that relative to this spend and cost containment efforts by employers, the second bullet, are the result of a fairly lengthy, protracted recessionary environment. This long-term situation we consider we are planning on extending into the foreseeable future. And the reason why that's important, Brian, is that understanding risk and understanding sustainability relative to revenues throughout the industry is directly impacted by these kinds of factors. In 2012, we did get some clarity relative to regulatory influence with the constitutionality of PPACA being adjudicated in the U.S. Supreme Court. One thing that we have noticed relative to these cost trends and the level of uncertainty is that PPACA is directly impacting that. In other words, we've seen an accelerated cost trend as those trying to prepare to manage risk associated with implementation of the law are working their balance sheets and working their profit loss statements. So there are four key things that remain in flux that have essentially created a more weakened investment confidence associated with the markets. Number one is the nature and timing of the state exchange openings, which we've just gotten word recently about the delay of 1 year relative to that. The expansion of Medicaid eligibility, the constitution of minimal essential health benefits and that definition, and then of course the long-term funding or payment mechanisms for ACOs. All of these, the delays and uncertainty, the state and commercial payer readiness issues are resulting in a more weakened or investment confidence situation. What is interesting, though, it is a very, very large industry market, $3.2 trillion. And like most situations, companies don't like uncertainty, and that gets reflected in the markets. So to the extent that businesses react to this uncertainty and how they react to the uncertainty directly impacts the financial markets. And I'd like to just point out a few trends that we've picked up on relative to implementation. The employer-employee relationship, for example, is going through significant transformation. And I would imagine that a lot of our listeners have probably heard about several of these trends. One might be the 30 is the new 40, when we think about a 40-hour work week, 30 being designated as part-time and implementation of the law at that particular threshold gives them relief. Second is company size. Under 50 employees, much more flexibility. Over 50, compliance. So the trends relative to the waivers, the booking of additional projected costs, fairly conservative treatment typically in both public and private companies is having ripple effects in the supply chain, so on and so forth. So from an investment community standpoint, we see a bit more weakened investment confidence factor that's driving the markets.
So what do you see from an investment perspective then? You touched on the weakened confidence, but how is this, let's dive a little deeper into how that's affecting investment.
So what markets do like are whether things are trending up or trending down, any kind of change creates opportunity. So anybody thinking about the stock market, puts and takes, and so on and so forth. So what we've been seeing is quite a bit of industry consolidation, significant consolidation, both in a vertical and a horizontal way. And let me explain what I mean by that. Vertical integration would be the consolidation in a supply chain, for example. It may be hospital system buying physician networks or physicians individually. That would be an example of vertical integration. Horizontal integration would be a physician practice that is growing 1 or 2 physicians a year through acquisition. So there may be 2 or 3 practices that may be merging. So several examples related to this vertical versus horizontal might be West Penn Health System Hospital merging with Highmark, which is a Blue Cross Blue Shield insurance in Pennsylvania. Hospitals buying physician practices. You can open up the Wall Street Journal on any one particular day and you're going to read 1 or 2 announcements or reference to announcements. And whether they're buying whole or majority ownership, there are consolidation occurring. Another interesting example is Tenet Hospital Network buying Conifer, which is informatics and data firm. What's interesting about that one, here we have a vertical integration going on. When I think about a perfect horizontal example of horizontal integration, Conifer buying Dell's healthcare practice and MediHealth and Inframed. Here you've got an investment by Tenet now in Conifer as a platform for informatics and data acquisition. So what Tenet was investing in was a horizontal or platform investment that they were planning on growing acquisitively as well. So here you have Conifer as a horizontal example. Advocate, of course, buying Sherman Hospital in Elgin. This is a hospital health system, $5 billion, 13 different hospitals. Buying Sherman Hospital in Elgin continues their acquisitive growth strategy associated with that. Advocate buying Condell, of course, is another good example. We see trends in dental practice integration, aggregation going on a daily basis as well. Cadence Health, another example. Central DuPage Hospital buying Delnor, Geneva-based hospital system. So here you have a geographical expansion, but still localized intent on that particular horizontal. The last trend I'll describe here too as well is as this industry continues its vertical and horizontal integration, it begins to look to other industries for best practices. One good example may be Creative Health hiring both their CEO and COO from outside the direct healthcare management system. And to that extent, the COO being a supply chain expert, a process person, is injecting a different kind of talent into the industry. Increase the second bullet relative to the response there. The increasing leverage, the idea is to create cost efficiency or scale. And when we get to the discussion about valuation, you're going to find that that's very, very important. And as well, the revenue size advantage, lower risk, more resources in being able to deploy and grow. But I would say that most large players in the industry, from a consolidation standpoint, are paying attention to a hybrid growth strategy. And what I mean by that is you're combining an acquisitive growth strategy, which are specific precipitating events, an acquisition of operations and other systems, along with paying attention to the organic growth strategies in each of those holdings. And that's where merger or post-merger integration becomes a key issue.
So based on these trends, where are the hot sectors from an investment perspective in healthcare?
Well, I would say that the markets are essentially pointing to 4 key investment theses that are being played out in transactions on a daily basis. First is the cost containment or outcomes. Several examples we have there are wellness, electronic scripts, EHR systems, those sorts of things. So those that are oriented around cost containment, profit protection, those sorts of things. Payment reform, that would be the ACO bundle payment strategies, quite a bit of investment going that direction. Whether they're overtly into ACO or more into understanding payment strategies and re-engineering the associated financial processes around that, that's where we're seeing investment. The new care delivery models, too, emergence of centers of excellence and those sorts of things. And then, of course, a very large trend that you see on a daily basis, as I mentioned, is the hospital-physician alignment. And the examples we gave relative to the vertical-horizontal integrations kind of lead into that. There's another trend, which is just now, I'd say, 12 to 18 months out, or into, rather. And that is differentiating between healthcare light and healthcare heavy deals. Now, what we've been accustomed to is healthcare heavy, which typically is defined as subject matter expertise being relatively deep. Networks are very well established, so on and so forth. Those tend to be the largest and most prolific valued deals as well. But what we're seeing now is a shift to this healthcare light investment opportunity, and that consists of things like retail health, healthcare-related IT, outsourced services. In this case, we're seeing an influx of a lot of new money, a lot of diverse money. In other words, there may be a fund or a portfolio that's primarily invested in a different industry that is looking for a diversification of portfolio holdings and may be looking at healthcare as a way into a very large investment opportunity. But what they know may be point of sale. They may know consumerism. They may know retail much, much better. So what they are doing is gravitating to those healthcare-related areas of the industry that are retail-oriented. And what we're finding is, as there is more money of this type coming into the industry and being invested in the industry, it's making the markets. It's essentially driving certain trends relative to the industry. Of course, the investment in practitioner aggregation spaces, and I'll say it again, we read about what is happening in that space on a daily basis, and that continues. And we anticipate that being a continuing trend for quite some time. Also, the practitioner aggregation that's going on, one of the key trends, if you will, or factors, is reimbursement protection. So as we see that the shrinking and predictably shrinking margins relative to a primarily Medicare-based practice is searching for diversity relative to revenue generation. So you may see combinations of an 85% Medicare-based practice with a 50% Medicare-based practice. And so there's a strategic objective there to diversify revenue sources. Other trends that we've seen, dental and urgent care, vision clinics are very popular. Some of the more contrarian long-term would be home health, accountable care, and independent practice associations. One other comment I'd like to make, Brian, too, as well. This shift to consumerism and the whole healthcare light retail health. The country has actually seen and been through already the leading edge in that shift to consumerism. And it was in the pharmacy benefits management arena with Express Scripts, Cardinal Health, and others evolving to the current CVS, Walgreens, Rite Aid mail order. That shift to consumerism is something that we continue to see in other areas of the healthcare sector.
Interesting. Maybe you could say a little bit more, and I gather that it's related to this, but the interest in dental, urgent care, and vision clinics, that is part of that consumerist drive?
Yes, and for example, with dental, the price points are fairly well known, and they tend to be a bit lower. They're more contained. So you see the aggregation of dental and the investment in dental being more of a geographical footprint-oriented margin preservation play as well. So these are those services that being closer to the patient makes a lot of sense. The more sophisticated life or death sort of procedures and those combinations across hospitals and primary care physicians, that sort of thing, are the ones that are aggregating more horizontally first, and then as they get to a certain size, they get to a tipping point, they become more attractive to an upstream supply chain component. So that would be, a good example of that would be multiple physicians combining to form a practice that for a particular geography makes sense to a regional hospital to acquire. They're basically acquiring their opportunity funnel relative to those advanced procedures, which tend to be those with higher margin. So that's really what's driving those. The other thing is the dental, urgent care, and vision clinics. Again, back into the healthcare light. It's right on the fringe. It's much easier to shift those kinds of practices to the retail health business model than it is the more complicated procedures.
That makes a lot of sense. Yeah, that makes a lot of sense.
Okay, good.
So how can we better understand the investment lens when viewing a physician practice?
Well, I'll tell you. Okay, so there's a lot of I think ways to think about how to answer this particular question. And what I'd like to start with is just understanding valuation and the concept of valuation. Whether it is a private equity firm, hedge fund, large money center, or it's a bank, or it's a physician practice that needs to expand their working capital requirements, or has an AR issue and is in search of some kind of assistance, financial or economic assistance, those sorts of things. The valuation becomes the centerpiece for investment of all kinds and types. And it primarily is heavily influenced by two things. One is sustainability of revenue, and second is how well that particular business practice has quantified and qualified risk, and how they have either managed that risk, remediated that risk, or taken care of risk elements, developed scenarios to deal with that. So you think about valuation. Essentially, you're trying to reduce to a number a practice or a system or a business entity of some sort. Now, the investor, think about it from an investor side. If you feel like your particular practice is absolutely optimized, there's no opportunity or for improvement, no incremental value that could be added with additional funds and that sort of thing, how attractive would you be to investment? Well, if you're pretty stable relative to the income, there's a fairly well-defined income. In general, though, investors are looking for an incremental benefit that their money brings, number one. And number two, if their money is smart money, in other words, it's not just about finance, it's about the type of investor that you're attracting to the practice or to the system, is healthcare centric. In other words, they know what it is that they're investing in, they understand the risks. That's a different kind of dollar. And not all dollars are created equal, believe it or not. So when a practice is evaluating the value or beginning to set out in understanding better the value of their practice, understanding, and we're not going to be able to go through as much detail as I'd really like here, but there's basically three methods to valuation: asset, market, and income. And I'll just very quickly go through some of the benefits of each. Asset is a very straightforward process. You're essentially taking all the assets in a firm business practice and restating them from book value to fair market value. Typically, an asset valuation would be used in situations where the practice may have had historical losses or has a nominal projected cash flow. So that's essentially where an asset-based valuation process would benefit. The market. Problem with market, and we'll go through a description here very quickly. It can be misapplied very, very easily. It's very tough to get an apples-to-apples comparison. But basically, what it's looking at is it's applying market multiples to various operating metrics. Now, let's say revenue, the price to revenue, the price to earnings before interest, tax, depreciation, amortization. That's a phrase for those that are just getting into the valuation vernacular. EBITDA is a term that you're going to hear fairly regularly. Price per physician is another valuation or market-based valuation metric. So essentially, you're applying market multiples to various operating metrics, and those are a few of the metrics that you would use. So you're looking at also other transactions and prices paid for those other transactions to be carried through. The problem with that is, unless you get down to a level of detail that really you get a confidence that you're comparing apples to apples, it's very difficult to apply. Income, the third, is you're essentially generating a forecast of operations influenced by physician compensation. There's what's termed a terminal growth rate, which is these typically an income base valuation would take the next 5 years of forecast of operations, projected revenue, and on the cost side, the physician compensation. And then after that 5 years, will make certain assumptions relative to the growth rate, so on and so forth, and we'll put a terminal number down. And then the fourth, which is probably more important and probably influences the valuation, is the discount rate. And this is the return on investment that any investor would expect. And there's an inverse relationship to that. The higher the discount rate, the lower the value. And that's the way a physician or a physician practice can value the kind of money that's coming their way based on the discount rate. So, and a couple other nuances that I'll throw out too. This physician compensation, unless the assumption is from the buyer, you essentially are not creating a fair market value calculation. And the idea is that all of these processes and all these methodologies for establishing valuation has got to meet several laws and was specific to healthcare. And fair market value is the only one that meets two of the three outright. First is Stark law. This law prohibits physicians from referring patients to an entity which they have a financial relationship with. The second is an anti-kickback statute, which majority of our audience are probably familiar with, but prohibits payment or remuneration in exchange for Medicare referrals. There's also, the third would be private inurement. So this relates to controlling tax-exempt entities providing excess benefits to non-tax exempt individuals. But bottom line is that you can't use just one valuation approach. The best way to establish a valuation, particularly with physician practices and systems and that sort of thing, is a combination of the three methodologies. The influences relative to the fair market value would be the number of physicians, the Medicare reimbursement, competition, expense assumptions. There's a wide variety of different geographical footprint, whether there's a brand that has been developed as a result of the financial condition, growth, operational considerations. There's a wide variety of different factors that get rolled up into the calculation. But the bottom line that I'd like our listeners to take from this particular slide is that there are essentially two types of investors. There's financial investors and there's strategic investors. And to the point on the Holy Grail, if you are a potential target or you're thinking about an exit strategy or you're trying to put a value on your practice, you're trying to figure out whether you're in for the next 3 years, you're going 10 years, you're thinking about 15, you're developing those scenarios, identifying and being able to be attractive to a specific buyer for your specific practice is going to generate the highest value number that you will see. And that is a strategic or an investment value, and that is between a specific buyer and a specific seller. And what gets taken into account there is way beyond fair market value. And it represents a synergistic or a strategic reason that an investor would be attracted to that particular target. So an example of that would be comparing fair market value to investment value or strategic value. In the case of reimbursement rates, fair market value would go to market averages, whereas a strategic or investment value would be a regional hospital or provider-based reimbursement rates, which may be higher. On the cost side, you're going to use market averages for fair market value assessment, whereas you can take credit for economies of scale in investment value or strategic value. So understanding that strategic versus financial buyer and investor is fairly important on this particular part of the discussion.
Well, this is probably far too big of a question, but I'm going to throw it out there anyway. The Holy Grail, it makes a lot of sense why that strategic investment would carry a premium with it. How then do you quantify that in making that evaluation?
Well, what will ultimately happen is all of the sub-calculations relative to revenue as it relates to sustainability, to margin, to cost associated with supply chain costs that you worked into coming up with your projected earnings. Also, other factors that typically are not part of the other three. It may be that if you have a platform investment of physician practices, for example, and you're looking to become a one-stop shopping relative to providing care, you may be looking at specialties, adding specialties, or adding ancillary services, or adding a number of different retail channel opportunities for creating potentially additional revenue in some of your existing holdings. So what it's doing is it's placing a value on that specific buyer's strategy moving forward, as opposed to just strictly the physician practice's past earnings, past revenue, even some of the quantifiable future earnings and revenue, which may be population growth determined, and there's a number of different factors that that practices can also use in projecting their revenues. But the bottom line is you've got a specific buyer that is placing a price premium on that practice because it fits a particular strategic hole that they have. That's why I term it the Holy Grail. To find that kind of buyer or investor takes knowing that they're out there, number one, and takes understanding how to be attractive to them and how to network properly. And we're going to get into some of the approaches to the market that a practice of that type would take, things not to do, for example. But
well, it makes sense.
Help to answer part of your question.
Yeah, it makes sense that you call it the Holy Grail because obviously it's a more difficult opportunity to find, but the opportunity is also more valuable in the ways that you're describing.
Absolutely.
So what current issues and issues on the horizon pose risk to maintaining the valuation of a practice or a medical organization?
Well, we've basically got a slide of alphabet soup here, but
welcome to healthcare.
When I think about doctors and physicians and practices, particularly of the smaller nature, it can really be inundating. The number of requirements, regulatory or otherwise, that are being foisted on what used to be a fairly I would describe as cottage industry, now is maturing to the point, and the controls and the requirements that are being placed. So I think when I think about the long-term risks, and now this is coming from an investor standpoint. This is coming from a financial investment risk quantification qualification standpoint. Compliance is number one. The physician quality reporting system, Medicare, EHR, the meaningful use requirements, the comprehensive primary care initiative, the ACO, and where we've been relative to now they're called ACOs, but where we were, several years back with the attempt at an ACO type structure, the conversions, ANSI 5010 and the ICD-10, 9 to 10, what's going on there. HIPAA, it's been around for quite some time, but I would put all of the requirements associated with compliance kind of in a bucket. When I think about risks too. So now let's talk a little bit about the risks before we get to investment quality. These conversions, 5010 is pretty much boat sailed, but as an important precursor to ICD-10, you blow the ICD implementation, disruption in cash flow in a declining revenue environment is not investable. So now here you've got a program implementation. You've got details relative to how business and work operations are going to be impacted relative to compliance with a particular mandate, directly impacting the profitability, the revenue prospects for a business. And again, thinking about a business as opposed to a lifestyle or a job is one of, I think, the first steps in getting prepared, and we're going to step through a few of those advice items too as well. When I think about HIPAA, you just had, I believe, a webinar on the Armageddon of HIPAA compliance. And having your act together with that, improving, it has a direct impact to valuation improvement. Because think about it from a risk standpoint. A breach can be devastating relative to fines, reputation, so on and so forth. So here's a risk on an implementation and a program and a technology and a process that needs to be in place for survival, much less sustainability. Meaningful use, another good situation. And how much is influenced by precipitating events, legislatively, politically, or otherwise, regardless of your political affiliation. There are influences, and recognizing that from a financial impact or economic impact on a business is important. Massachusetts Medical Society is fighting right now with the state legislature, who passed a bill requiring meaningful use of health IT for doctors to maintain their licensure.
That's a great example.
Beginning in 2015. So those are the types of things, and as our audience, if they're planning on getting into the acquisitive growth strategy or buy-sell opportunities, that sort of thing, they're going to find out that quantifying, qualifying risk associated with their business is going to be first and foremost an issue. And number two, being prepared for an investor, a group, a hospital, whoever it might be, doing due diligence on their firm is going to be something that's going to take deliberate action, and it's going to take some time to prepare for that kind of microscope view into their business. The second category, I would say, would be the investment in quality, the ability to invest in latest medical and diagnostic equipment, the avoidable readmission. I've just given a couple of examples here. Declining reimbursement. Essentially now, over 85% Medicare, knowing there's less control and knowing there are shrinking margins. That investment, think about it, how investable is that? The rate of industry consolidation, all the things that we've been talking about, the vertical horizontal integration, the creative joint ventures and collaborations that are emerging, the shift to retail, so on and so forth. This sell, buy, or maintain relative to timing is directly influencing the consolidation of the industry. Now the emergence of this light, the healthcare light investment, there's billions of dollars coming into the industry now focused on that retail shift. Well, did the industry see that coming 5, 6, 7 years ago? Maybe, maybe not. But I will tell you, a follow the cash mentality relative to not only operating the practice as a business and as well in viewing the investment market, where money comes from and where it flows to, would be instructive for any of the provider folks that may be on the phone that are looking into this.
So how can a practice then begin to assess options for securing a more solid economic future?
Well, I would say the first thing I would do, I'm going to make a book recommendation here. E-Myth Revisited by Michael Gerber. It essentially is all about, and actually there's a version of this book out specific to healthcare, doctor practice, that sort of thing. But essentially what the essence of the book is working on your business as opposed to in your business. It's just shifting, and it's not an either or. Obviously, physicians need to, you're going to see patients every day, and so you are the business. But the reality is, if what you're trying to do is improve valuation, the perspective of understanding your practice as an asset, as a business, is the first step. So what that book basically does is it walks you through pinch points and perspectives and so on and so forth of decisions that are made that may not be consistent with a valuation exit strategy, based exit strategy, creating an asset as opposed to maintaining a job or a lifestyle exclusively, and essentially not being able to be positioning yourself for an exit strategy that has a payoff at the end. So after, I think, getting that perspective or that mind shift relative to thinking about the practice, setting both personal and practice goals with specific time frames. If you're 54 years old and you decide, I've got, I believe, 5, 6, 7 years, here's a specific personal goal that I have, both economically, financially, or time frame wise, or where you are in your life continuum with family, whatever it might be. Reducing to writing goals and putting specific time frames around them actually helps quite a bit. And to understand where those stakes are in the ground relative to the future makes a lot of sense. As it relates to the practice, make sure that they're valuation centered. Okay, so if achieving a particular revenue, achieving a particular number of physician basis, geographical footprint might be an issue, then work it. Next item I'd say is get smart. The transaction landscape that I've described to you as a point event, it's a point in time. Things shift. I would say, as a minimum, looking at some of these macro issues at least on a twice a year, but some of these micro trends, looking at them on a quarterly basis, getting plugged into the market of where that practice is operating would be very, very important. We've talked about it a little bit already, the financial versus strategic and the valuation approaches, but just get smart. Understand better who it is and why it is you would get into this particular potential transaction environment. And then think about over that, if you say you have 5 years, 10 years, 12 years, 17 years left, assess your organic, acquisitive, hybrid options. You're going to want to grow the practice organically to improve valuation, but you may be in a position in 2 to 3 years to potentially acquire. To become acquisitive takes a deliberate strategy and a mindset. Aligning deliberate positioning as a buyer, seller, or collaboration partner, as I was saying. You will make decisions financially differently 6 months from now if you decide that 5 years from now you want to be twice the size from a practitioner level. And begin preparation. There's I think a recent study by Association of American Medical Colleges projecting over 91,000 physician shortfall by 2020. And a lot of the reasons: increased compensation, increased hospital reimbursement. A lot of the physicians are either going the employment route or looking at a number of other different scenarios. But the reality, if this is true, then in my view, it creates an opportunity. So I think looking at trends like that, and several of those that we've talked about already, just getting immersed in the market definitely gets you better prepared for this kind of scenario evaluation, opportunity triage, if you will, relative to what your options may be.
So let's talk about how a practice can begin to build toward that increased valuation.
Okay. Well, I would say that there's two areas. The first area is operationally. And think about it. We've already talked about the revenue, sustainability, and risk, quantifying, qualifying risk. So just to focus on the revenue for just a minute, the business model, what your referral network looks like, if you're building a brand relative to best-in-class practices or outcomes, the risk of flight relative to the patient base, how much of that is generationally developed. In other words, parents have kids, kids have kids, and so on and so forth. How embedded you are in a particular community, what your geographical reach might be. The second is in understanding better risk. And it got three operative words here. Is first of all, as a minimum, compliance. But second is containment and remediation. It's understanding risk and understanding where the markets are going, where the industry is going, where the focus is going, and staying ahead of the ball, if you will, relative to the risk. The third would be profitability. And what I'm going through are things that, whether this was a practice, whether this was a hospital, whether this was a business, precision machining, injection molding, whatever it might be, these are the kinds of things that as a business owner would want to pay attention to over an extended period of time. Because the more you can demonstrate a historical attention to this level of detail operationally, the more investable your practice will be. The profitability, quality of earnings, understanding variable and fixed cost, and what might be done on either an annual basis or quarterly basis to contain costs, to manage the supply chain a bit more proactively. Also used by investors on a routine basis is you've got a set of books. There's going to be a completely different set of books that are generated as the basis for due diligence and understanding the profitability of the physician practice. The reality is, for sole practitioners and that sort of thing, you're in a tax minimization accountancy model. A lot of the add backs, in other words, things that may be justifiable business-related expenses that are unique to that particular owner, get added back and improves the profitability. So that's why you run numbers a number of different ways to come up with a range relative to profitability, which ultimately drives valuation, has direct impact on valuation. The business work process versus people dependencies. How transferable is your operational excellence, the way you do things, that playbook for how you do things, how transferable is it? A people dependency process tends to be viewed as riskier, whereas to the extent that business work processes are institutionalized, either in technology and systems, the better. So that gets to this next bullet is technology enabling and compliant. And I got to say, when I see valuation impacts and I see deliberate, and this is a wide variety of different industries, not just healthcare, when I see that kind of technology investment in streamlining business work processes, I know it's sustainable. I know that it is something that will survive change in ownership. It will survive an acquisition, integration type of situation. And the last note I'll make here is that relative to output from the practice, repeatable, predictable, high-quality output. To the extent that you're able to demonstrate the fact that all your processes are repeatable and predictable is highly investable. And I think about, we're back on the ICD implementation. Any of these breaches operationally relative to HIPAA or whatever it might be can basically shut down an operation, and that's why attention to that and getting a process orientation to that is so important. The second area that I talked about was the preparing financially. So yeah, it's actually the next slide.
Oh, I'm sorry.
There we go. So we talked a bit about not relying on a single method for valuation, getting a range. All of them are going to point to a different number. There are certain things that you're gonna be able to figure out if they're out of tolerance relative to intangibles, and I wish we had 3 or 4 hours that we could talk here, because there's so many nuances that I think practices would really love to hear about, that they can change things tomorrow that will have a direct impact on their valuation the next day. It's amazing based on what I've seen in practices and what I see in business just in general, that how much low-hanging fruit there actually is in practices. But anyway, not relying on a single method for valuation. Cleanse the information and the inconsistencies. The managing around outdated information is probably one of the number one issues relative to coming up with reasonable projections, so on and so forth. Where you have inconsistencies in financial statements relative to classification of costs, classification of revenue, accounting of revenue, the chart of accounts, that sort of thing, we could get into a whole accountancy-related type of dialogue on that. But the idea is having clean books, being prepared in advance of any kind of due diligence. And this isn't just practices that are trying to position them for sale. When you go for a $500,000 loan, or you decide that you're going to put in $1 million and you need 5 more to buy an adjacent practice that's 3 times your size. If you can demonstrate a fiscal prudency, a attention to operational and financial detail, a control, a management model that's working, you can show trends relative to growth, profitability, the ability to digest risk, whether that's in the form of mandates rammed down your throat or otherwise. Those all play extremely well into your investability. High intangible or goodwill value is a typical red flag. Valuations that are greater than 50% on intangibles typically get a lot more microscopic view and look. Inappropriate consideration of synergies, another area where the practice may believe that it's of much more value to a particular buyer or investor, and so the dollar value that you might put on the synergy number may be out of whack. They typically get close scrutiny as well. Handling of taxes is a huge issue, but again, strictly accountancy and financial planning. It's easy to knock out if your intentions and the goals that you set up are very, very discrete and specific, and if you have 3 to 5 years to prepare your practice for a potential exit or a combination, or prepare yourself personally to acquire a practice or two. If you have the time, the luxury of the time to prepare for that, these are very easy steps to accommodate. Poorly defined use for valuation. I run into this on a regular basis, and I think as an industry, we tend to confuse or obfuscate the intended use of the different methodologies that are provided earlier. I think the best course of action, the highest ground to take, is you calculate a number of different ways, and you apply a reasonableness judgment to what makes sense, and set a range. And you'll know whether you're at the low end or the high end relative to valuation if you're able to index to that. And obviously, if you're if you're lucky enough to be into the strategic or investment valuation range, it's Katie bar the door. I mean, your salesmanship relative to your brand, the complementary capabilities that you may bring to a specific buyer or investor or company plays very well in improving that valuation number.
So how can a business then avoid feeling like they're boiling the ocean in preparation efforts? I love that metaphor.
Well, I I like it too, because every time I review all the changing requirements that these poor practices are trying to handle, it's pretty can be pretty breathtaking. I think the first bullet that I have there, the paralysis through analysis or precision through revision, it tends to be you want to lock down every last detail, and trust me, there'll be plenty of time to lock down details. You got to get a general direction. When you're 80% there, move forward. Half the time, the issue with moving forward with a change is taking your foot off the bag. It's being able to let go and get an understanding of where you're going, what you're wanting to do. If you want second base, you got to be intent on getting second base, and what it means is you got to take your foot off the bag and start thinking a bit about how you're going to get there. A lot of times, you're not going to be able to get things to the 15th decimal point. It's just not going to work, and so that's what that first bullet is all about. What I found very, very useful in evaluating options, going through opportunity triage, preparing for the next 5 years to 10 years, some of the strategic planning, that sort of thing, is you formulate things that you're going to do tomorrow or a week from now or a year from now. into three, a stratification. If you could picture a pyramid in your mind, the top apex of the pyramid is a small, part of it called strategic. The middle band would be operational, and the base is tactical. A lot of the things that you do day in, day out, just do a time motion study of yourself for a week or two or three or four, and try to calculate how much time, how many resources, how many cycles, personal cycles you devote to either the strategic planning, the operational performance, or the tactical nature of your practice, your business, your life, that sort of thing. It kind of puts things in perspective. What you'll begin to figure out is that if you have a strategic objective to exit in 15 years, and you want to exit at a $10 million valuation, for example, that the fact that that is sitting as the primary goal or a goal relative to you and your practice, how that translates into strategies you launch, the operational decisions you make, and the tactical activities that are ongoing on a daily basis. Third bullet I have there is the opportunity triage. So based on the return on investment, how long it's going to take you to get to where you want to be and those goals, to what extent any of the activities that you'd like to fund, either out of operations or with outside capital or otherwise, to the extent that they become self-funded. So, for example, you want to add 3 assistants. To the extent that their salaries, benefits, so on and so forth, the cost, the structural cost of adding them to your business, to what extent or when do they become self-funded? In other words, you've increased throughput, you've increased capacity utilization, you've increased either flow, whatever it might be, that those 3 positions become self-funded. That, for me, and that logic, going through that logic, is a key enabler in evaluating whether you've taken E-Myth Revisited to heart or not, okay? Knowing where the money's going. Focus on high return or macro issues. There's one I'm going to give you right off one of the probably most pervasive is IT. The whole industry is transforming from a cottage industry to market-based. The IT strategy, when I think about the strategic, operational, tactical, the IT strategy connects more business and work process, has more ROI touch points than any other factor, and it's been this way for 7 to 10 years. The IT and connectedness externally and internally as a key enabler to expansion and growth. This shift to retail and consumerism is all tech-enabled. I did a study, actually the firm did a study, it's been about a year ago. We came up with 5 macro trends related to the industry. 3 of the top 5 were technology-based. Streamlining supply chain and merging channels, much easier to do with a fully implemented IT implementation strategy. And of course, I think people on the phone know better than anybody. The IT systems have been critical to all the compliance issues, virtually all of them. The examples of ICD implementation, the 5010, the HIPAA, so if I had to pick, and I think that's why this forum is valuable, if I had to pick one macro issue that directly impacts quantifying, qualifying risk, and as well revenue sustainability, it's a compliant IT strategy. And I hope that helps. That for me has been one of the salient points in driving valuations.
Absolutely. And, there's several broad themes that emerge here. Compliance is one, but that IT aspect of it is obviously critical as well. We are running short of time, so we're going to try to move through the rest of this a little bit quickly, but we are going to have you back as well, because I think this is the reason why this conversation is so important, is that there's so many practices out there because there is all of this, acquisition going on, and this is not territory that I think most people in healthcare are really comfortable with, and I'm sure that there's many practices being acquired that really aren't getting the valuation that they could be getting because they're not in this world and they're not considering these questions that you're raising.
I couldn't agree more, and I'll just very briefly go through this last slide because I think from a perspective it might be helpful. If
Absolutely.
you feel you're already optimized as a business, well, fine. You are a prime candidate as an organic growth engine for a future owner, whether that's private equity, hedge fund, larger practice, smaller whatever it might be. Those with the cash, those with the capital investment. You feel operationally confident. What private equity would view you if you're large enough as a platform investment. What they're going to try to do, they're going to buy you, and they're going to be, and going on down to item 4 there, follow the money. They're going to be buying additional practices, much smaller. They're going to utilize your operational brilliance, your operational expertise to roll up or tuck in additional practices. I would avoid at all costs. Unless you're in a turnaround situation, or you believe that you can command a price premium on the open market, then shop yourself out. But by shopping yourself out, you basically cut off the opportunity for strategic investors because they don't go that route. The rifle versus shotgun is, again, getting to a strategic or an investment valuation. And the last, if you didn't hear anything that we talked about for the last hour, the maximum value is going to emerge from a strategic buyer or investor or collaboration partner. That's where you're going to get the most bang for either your exit buck or otherwise. And if you ultimately are an acquirer, positioning yourself as strategic or financial is something to consider as well.
Well, maybe in our follow-up, you'll give us the magic formula for finding that strategic buyer. I'm sure that's that could one of many subjects we could talk about for several hours.
Yep.
Well, we did have some questions.
It was a pleasure talking.
It was our pleasure. As I was saying, I think this is really unexplored territory for a lot of our audience. And we did have some questions during the session, but I think we addressed them because they were mostly around compliance, such as ICD-10 and how that would affect valuation. But I think we wound up covering that pretty thoroughly. So we'll send the questions on to you and let you look at them. But I think that we addressed them well.
Well, certainly, and if any of those questions, we can add additional detail in the responses and that sort of thing. I'd be happy to do that.
Yeah, we'll follow up with those. So we invite people to watch their email boxes for links to the written answers to those questions. One way that practices could work through some of these questions is to work with a Third View Medical. You can see the URL on your website there, www.athirdviewmedical.com. You can go to that URL to learn more about our expert Michael Sarlitto and the services they offer through a Third View Medical. I'd like to invite our audience to look at our Certified Meaningful Use Professional course. If they do have compliance issues that they need to address, you can visit the URL on your screen to learn more about that course. It covers Stage 1 and Stage 2, the clinical quality measures that Michael mentioned, and it's really comprehensive education around meaningful use. Visit the URL to learn more about that. I'd like to thank you, Michael, for joining us today. It was a very informative session.
It was absolutely my pleasure.
And I'd like to thank our audience as well. Once again, we will be sending out a follow-up email with a link to the video version of this event, along with the slideshow, and we'll have written answers to those questions for you as well. Visit formatapproved.com to learn more about our upcoming learning lunches. The Learning Lunch button at the bottom of the screen will take you to our entire slate of upcoming webinars. Our next Learning Lunch will air August 20th, and we'll cover the subject of the whys and how-tos of becoming HIPAA compliant from a layperson's standpoint. So again, there's another opportunity to learn more about the compliance landscape. Thank you again, Michael. We'll certainly have you back to discuss these important issues.
Very good. Thank you very much. I want to thank everybody that tuned in.
And we thank you as well. Keep an eye on your email box on our homepage for other upcoming topics, and thank you again for joining us today.